All right, so today we're going to pick up where we left off with Valuation Model Part 2 of Costco. And where we finished off with the last model is we had forecasted out 11 years worth of financial statements, which got us 11 years worth of cash flows. Now we're going to value the company doing a DCF valuation, and we're going to value those cash flows. So if I go back to our lecture note 4, then McKinsey in the book talked about their valuation of Home Depot. And where we're going to pick up today is we're going to, when we got to this slide in the valuation of Home Depot, I mentioned that this was a DCF valuation of Home Depot. And I said this would be very important because eventually we're going to put this into our model. Today's the day we're going to put this in, into our model. So we're going to take the valuation of Home Depot and we're going to create a tab in our model that looks almost identical to this. Okay, so this is the process for doing a DCF valuation. And what we're going to do, this was talked about in the current readings, is we're going to create basically a defined value period of Costco, or an explicit valuation period, which we have arbitrarily set as 10 years. And then year 11 forward is going to be our continuing value period. Okay? So basically that's what we've done, is we've set up the model to forecast the cash flows. The first 10 years, we have 11 years worth of data are the defined period or the explicit forecast period. And then year 11 forward is the continuing value period into perpetuity. And in just a few minutes, when we value the company in perpetuity, we're going to use the key value driver formula to give us the cash flow valuation into perpetuity. Okay? So those are the pieces of the puzzle that we're going to start putting together into our model. So let's start out with our Excel model. And in this case, I'm going to go to the end and we're going to add a new tab. So I'm going to click on the plus button to add a new tab, and I'm going to call this tab the DCF Valuation Tab. Okay? And I'm going to change my zoom, make it a little bit bigger so it's easier to see and follow. Now, again, following the format that was in the book, we're going to eventually want to print this out on one sheet of paper, so it'll be easier to have the years go down the rows as opposed to across the columns. And we want to use relative references, so I'm going to start out in cell A2, and I'm going to refer to the first forward year of our forecast. So in this case, equals, and I'll pull it off of the Ratios tab. Our first forecast year was 2014. Relative reference equals previous year plus 1. And just copy that down 10 years to 2023. So again, don't hard code these numbers, because again, you want to use this as a reusable model, particularly for your group projects. Okay? Now, what we're going to do is we're going to do our valuation, and the first part is the operating value of the firm. So when we get the operating value of the firm, what we care about are the forecasted free cash flows. Okay? Now, those come off the CFI tab. And so when we forecasted the income statements and balance sheets, the model forecasted the free cash flows for us. So essentially, we're going to pull the forecasted free cash flows from 2014 to 2023. So again, relative reference equals, from the CFI tab, 2014 free cash flow, including goodwill. Free cash flow for valuation purposes always includes goodwill. So H12 is the first year of the forecast. All right, 2015 free cash flow from the CFI tab, I12. 2016 free cash flow, the CFI tab, J12. 2017 is K12. 2018 is L12. 2019 is M. 2020 is N. 2021 free cash flow is O. 2022 is P. And 2023 is Q. So just a visual check. HIJKLMNOPQ. So those are the free cash flows for the next decade, assuming our assumptions are true. So what we need to do is we need to present value these free cash flows, right? Because in order to value the company, we have to value today. We're going to put them into present value. So what I'm going to do is I'm going to use a process to discount them by multiplying by the discount factors. Discount factors is 1 divided by 1 plus R discount rate to the power of T number of years. Okay. So again, that's just the present value formula. Present value is cash flow divided by 1 plus R to the T or N. In this case, what we're going to do is we're going to take the free cash flow, we're going to multiply it by the discount factor, which is 1 over 1 plus R to the T or N, and then that will give us the discounted free cash flow. So in this case, discount factor equals 1 divided by, left paren, 1 plus the cost of capital is going to be, off the Assumptions tab, the WACC. That's the cost of capital we're going to use to discount the cash flow. So if I divide by 1 divided by 1 plus the WACC, it's the same as multiplying by 0.9259. Okay. Now, in just a minute, I'm going to copy this down. So I want to make cell B4 an absolute reference. So I'm going to put a $ in front of the B, or string, and a $ or string in front of the 4. So assumptions, $B, $4. So that when I copy the discount factor down and paste it, it's always referring to that cell. Now, if I discount a cash flow in 2 years, I have to take 1 divided by 1 plus R squared. So in this case, I need to make sure that this is squared. So shift 6, it's called the caret function Excel, 2 squared. 2016, shift 6, 3. 2017, power of 4. 2018, power of 5. 2019, power of 6. 2020, power of 7. 2021, power of 8. 2022 to the 9th power. 2023 to the 10th power. Okay, so square 3, 4, 5, 6, 7, 8, 9, 10. All right, so those are the discounted factors. So if we multiply them by the free cash flows, that will get us the discounted free cash flow. Or another way of saying that is the present value of the free cash flows. So take the free cash flow times the discount factor. That's what they're worth in present value today. Right? And if I want to clean it up to make it a little bit easier to see, I could turn this into format cells, and I'll make this number 2 decimal places, just so it's a little bit easier to see. And in fact, it might be easier to see the discount factors as 4 decimal places. Okay. All right. So now, if I add those free cash flows up, I then get the operating value for the first 10 years of Costco in present value of about $12.2 billion. So assuming our assumptions come true, then Costco is worth $12.2 billion today based on how much cash they're going to generate in the next decade. Okay? So that's the operating value of Costco running their stores for the next decade. And then what we're going to do is we're going to say Costco continues to operate its stores after that, so we're going to put them into perpetuity. So we're going to then have a continuing value And the continuing value of Costco will be, go back to here, this formula, the key value drivers formula. Now the key value drivers formula says no plat in T plus 1, and what that means is the first period of continuing value, which in our model is 2024. So McKinsey talks about, as a best practice, when you forecast out the financials of a company, you always forecast one extra year, so that that extra year becomes the continuing value year. So in this case, we did 11 years. The first 10 were the explicit forecast period. T plus 1, the 11th year, is the first year of continuing value. So no plat T plus 1 is no plat 2024 in this particular model. Right? RONIC is our 2024 ROIC. Right? G is the long-term growth rate into perpetuity for G, and the WACC is the WACC. Okay? Now, again, because I want to keep all these assumptions in one place, if I ever want to change them, I'm going to make sure that all these assumptions that I'm going to build the formula off of are on the Assumptions tab. So on the Assumptions tab, I need to have a continuing value no plat. I have to have a continuing value ROIC or RONIC. And I have to have a continuing value G. And I'm going to make these yellow because I could theoretically change these in the future. Now, right now, my continuing value no plat equals TII is where we had created our forecast for no plat. So we have a forecast for no plat in 2024. So ours and Robert 4. Continuing value ROIC equals, we forecasted ROIC on the EP BOY tab. Very important to use beginning of year ROIC for this exercise because we're about to also do an economic profit valuation. We want the DCF and the EP valuations to exactly match. And the only way, I told you before, that they exactly match is if we use beginning of year invested capital. So therefore, beginning of year ROIC. So don't use the EOY tab. Make sure you refer to the BOY tab. So in this case, my ROIC after goodwill, row 15, Q 15. Now, I made a mistake in the file that I uploaded, and I gave you an extra year by mistake, which wasn't being forecasted. So in the BOY 2025, you can just wipe that out. That's why it's 0 anyways. Right? So basically, 2024 is the last year, so it's Q15 is what we want to have here in the Assumptions tab. For CVG, we're going to say 3%. So the assumption for growth, this is long-term growth and cash flow to perpetuity, is we're going to say companies generally grow at the rate of the economy long-term. Most Western and U.S. economies are expected to grow about 2 to 3%. We're going to start out with a ratio of 3%. Okay, that was the growth rate of the U.S. economy for the last 100 years. So assuming a mature economy should grow around 3%. Now we know that generally G's this semester are going to be between 0 and 6% for very long-term growth, perpetual growth. And the idea for G is that by definition, G can't be greater than R. Because if the formula for growing perpetuity is cash flow divided by R minus G, G has got to be lower than R, which is your discount rate. Right? So growth into perpetuity can't be higher than the cost of capital. Right? So in this case, we're going to start out with an assumption of 3%. We can always change it later. Right? So I have my 4 assumptions. Just do a little bit of formatting here. I'll make this currency. I'll make this a percentage. Change my format. 2 decimal places. And same thing here. Just so I can see. All right. So now I'm going to start filling out my continuing value equation. So I'm going to come back to my DCF valuation. And for continuing value equals, basically going to put in this formula. So left paren from the Assumptions tab, no plat times left paren 1 minus the CVG growth rate divided by the ROIC, right paren right paren, divided by left paren, WACC minus growth, right paren. So about 65 billion and change. Right? So for now, I'll just pop this formula back on the screen so you get the correct order of operations here. But basically, that's going to be your biggest challenge here, is just make sure you get the right order of operations in this formula. Right? So essentially, in continuing value, Costco, we're saying, given these assumptions, is worth about 65 billion. But I have to present value that. Okay? So I'm going to use the same discount factor that I used in 2023. Right? And you might say, gee, why am I using the same discount factor in 2023 as 2024? And the answer to that question is, implicit in the key value driver equation is a discount rate. So we've already discounted the year 2024 by using the perpetuity equation, the key value driver equation. So we don't want to double discount 2024. So this brings us back to the beginning of 2024, which is for all intents and purposes the same as the end of 2023. So in this case, that's why I'm using the 2023 discount factor. So to present value that, take that cash flow divided by the present value, or the discount factor, and that present value is the continuing value. So what we're really saying is that the operating value of Costco is going to be the sum of those two numbers. The first 10 years plus the continuing value period, or about 42.4 billion and change. Questions about what we just did? All right, that's our forecast for the operating value for Costco. Right? Now, what we're going to do is we're going to add in 1 plus 2 equals enterprise value. Now we're going to add in the non-operating values for Costco. So now we have to add the non-operating assets. Well, conveniently, we've labeled the non-operating assets on the TFI. So from the TFI, we have labeled 3 non-operating assets: excess cash, non-operating assets, long-term investments. So in this case, I'm going to highlight each one of those. So I have my excess cash, net non-operating assets minus the non-operating liabilities, and long-term investments and long-term receivables. And here's the deal. I'm going to use the 2013 values, which are my current values for each of these, which are already in present value. Okay? So excess cash equals, from TFI, my 2013 excess cash balance, and the values for the next two down. Because basically the implicit assumption we often make is that most non-operating investments don't create a lot of value long term, so therefore any new non-operating investments are NPV 0. Right? So therefore we're just going to value the non-operating values today. But you don't get any new NPV investments out of non-operating investments. Think about the whole beat the market approach. It's hard to invest and beat the market. Same thing for companies. It's hard to invest and beat the market. Right? So that's the assumption we're going to make. Now, if there is an example of a company that consistently beats the market, we could choose to forecast this differently. But for the vast majority of companies out there, no one really does. Okay? This is the way it's going to be done. So what we're going to do is we're going to then create the enterprise value forecast. And the enterprise value is the operating value plus the non-operating values. Just sum them up. Those four things become the forecasted enterprise value for Costco. Right? Now, one minor adjustment that we're going to make in the future is right now Costco doesn't really have any long-term investments in other businesses, but other companies do. So we're going to go to the assumptions, and we're going to put in an assumption called the P to B, or price to book multiple, of long-term investments. And we're going to start out with an assumption of 1. And I'll make this yellow. But the idea is, if the price to book ratio is 1, that means the company trades at book value. The price divided by the book value. P to B of 1 means your book value. So the idea is we're going to take this DCF valuation multiplier of the P to B and multiply it by the long-term investments. So long-term investments by the P to B multiplier, price to book multiplier in the assumptions tab. You might say, gee, why are we doing this? Well, the reason we're doing this is because we actually care about market values. And the way accounting works is that if a company does make an investment in another business, they record it on their balance sheet at the price they paid, the book value. They don't put in the market value today. So for example, a few years ago, Microsoft made an investment in Facebook. They bought about 1/15 of Facebook. So on Microsoft's balance sheet, they have the book value of Facebook from about 6 or 7 years ago, whenever they did the investment. They don't have the value of Facebook today, which is much higher. So that's the point. If I were valuing Microsoft, I'd want to multiply that book value of investment by some adjustment, the price to book multiple, to get a fair value of Facebook today. All right? If I were valuing Yahoo, the value of Yahoo today is all Alibaba. That a few years ago they made an investment in this company called Alibaba based in Hong Kong, and essentially that 40% stake in Alibaba is all of Yahoo's stock price today. All right? So their operations, virtually worthless. Their entire value is based on the non-operating value of Alibaba. Yet if you looked at Yahoo's balance sheet, you wouldn't notice that because they paid a pittance for Alibaba a long time ago. Now it's worth a princely sum. So that's the point. I need to be able to adjust for that if I'm valuing Yahoo. That's the price to book multiple. I don't have to worry about it for Costco, but I'm setting this up as a reusable model. All right. So back to Costco. Costco has an enterprise value that we're forecasting, assuming these assumptions come true, of about $46 billion. Now we got to get the share price. So 1 plus 2 equals 3 plus 4. I now have to have the debt and equity equivalents. But what I'm really trying to do is I'm trying to solve for common equity value. So I have to pay off all the debt, pay off all the 3s, and I have to pay off my non-common 4s, and what's left is going to be the equity value. So, again, TFI. On my TFI tab, I have my debt equivalents, so retirement-related liabilities and interest-bearing debt. I have my non-common equities, so I don't want to pay off the common equity because I'm solving for that, but preferred and minority interest. And again, I'm going to use the 2013 values, which is the current amount outstanding, for retirement and interest-bearing debt, and the 2013 for preferred and minority shareholders. Those are, if I go back to my TFIs, those are the 4 items: retirement-related liabilities, interest-bearing debt, preferred stock, and minority interest, that will be paid before common shareholders get what's left. Okay, so what I'm going to do in my valuation is say that my common equity value equals the enterprise value minus the sum of those 4 things, or about $40.7 billion. $40.77 billion. Sorry, was there a question? So I just took this minus these 4 things. So D22 minus the sum of D24 to D27. You could also just individually subtract them, if that's easier to do. But that's what we're saying. We're saying Costco's worth about $40.7 billion. Finally, I need to get a share price. So I need to know what are the shares outstanding. And if I divide the common equity value by the shares outstanding, then I get my forecasted share price. So again, I'm going to want to use this model again, so I don't want to put in Costco's actual shares outstanding right here. I'm going to go to my assumptions tab, and I'm going to create another assumption for shares outstanding. Again, just good model hygiene. I want to basically put my assumptions in as few places as possible, so it's easy to remember that I need to change them, and I don't want to hard code numbers in. Because if I hard code numbers in for Costco, and then let's say I'm valuing Disney, Disney has a different amount of shares than Costco, and I won't understand why I have to make some crazy assumptions to get close to Disney's share price, because I have the wrong shares outstanding. So this prevents me from doing this. So in this case, I got to look up their shares outstanding. Well, this is where Bloomberg comes into play. So in Bloomberg, one of the fields, one of the screens is called the description screen, DES, for any company. So if you're on a company screen, you type DES or click on DES. Down here on the left, shares outstanding. All right, so I can quickly get the shares out for any company on Bloomberg. 436.9 million. So back to Excel, 436.9. So back to my DCF valuation, I refer to that cell. Forecasted share price equals common equity value divided by shares outstanding. So format that as a price, $93 a share. So what we've basically done is we've said that assuming all of our assumptions come true, then Costco is worth about $93 a share on a cash flow basis. Right? Now, today, at time of valuation, Costco is trading at $119 per share. So this is the point we were making before. I know the price, so what I can do is I can figure out what are the cash flows that get me the price. Right? So that's where we're going to go next. That won't be today, but that'll be our next session. And during the next session, we'll talk about how we do what's called an as-is valuation. We'll talk about how we adjust assumptions to get very close to the current share price. Right? So don't do this yourself right now. We will do this later. But just as an example of this, if I want to understand what must the market be thinking to get to a $119 share price, I can go back to my ratios tab as just a quick example, and I could say, instead of a cost of goods sold of 86.5% and a gross margin of 13.5%, what if it were 85.5%, 1% lower, and therefore 1% higher gross profit, 14.5% instead of 13.5%? That 1% change in gross profit would change my forecasted share price to $139 a share. $45 change in share price by a 1% change in their gross profit margin. Because that's the impact of the cash flows on a company that size compounded out going forward at that growth rate. So this is what I'm saying. Eventually we're going to get into, and this is the key, the art of valuation, which is coming up with the correct assumptions. But what we're going to do in our next session is we're going to do what's called an as-is valuation. So we will make some changes to these assumptions. So I'm undoing this. So right now we should be at 93. But we'll make some changes to the assumptions to get very close to the current share price, to get an idea of what kind of assumptions must the professionals, the institutions, be making to value Costco today. And then we'll look at the assumptions and we'll say, are these the assumptions we would make? Maybe they're not. Maybe we believe in different assumptions. Then we put in the assumptions we would make. That gets us a targeted share price that is our share price. And that creates a buy, sell, hold. Because our assumptions lead to what we think the share price should be. We compare that to the actual share price, and then we can make our recommendation of whether you should buy the stock, hold the stock, or sell the stock. That's the cash flow process that the analysts are basically going through with their valuations. Right? And that's where we're going next. But for purposes of building the model, we all want to just, with these assumptions, get to this share price. Questions about any of that? Okay, almost done, but we got one more valuation to do. I said we were going to do 2 valuations this semester. We're going to do a DCF, and I also said we're going to do an economic profit valuation. So now we need to do the economic profit valuation of Costco, right? So again, I'll go back to PowerPoint lecture note 4. And when McKinsey did the valuation of Home Depot, few slides later, we showed you how they did an economic profit valuation of Home Depot. So that's what we're going to do now. We're going to do the economic profit valuation of Home Depot, right? And get the same answer as the DCF valuation. In fact, that's going to be your final exam. Your final exam is doing exactly this, right? So here's the point. What we know about the economic profit valuation is that the only difference in how you calculate it is how you calculate the operating value. Everything below operating value is the same. The only difference is how you calculate the operating value. So what we're going to do in our model is we're going to take our DCF Valuation tab and we're going to clone it. The easiest way to clone it is to right-click over the tab with your mouse, move or copy, create a copy, slide it down, move to the end, hit OK, and that'll basically create a copy of that worksheet or tab in Excel. Exact copy. Now it's called DCF Valuation 2. And then what I'm going to do is I'm going to rename this tab EP for Economic Profit Valuation. So I now have a second valuation tab called EP Valuation at the end. And I want these two tabs to give me the same answer. So here's what I'm going to do. When I do the economic profit valuation, here's what's different. I'm no longer forecasting free cash flows. What I'm forecasting are economic profits. So I need to clear out these references to the free cash flow. Right? And I use the same discount rate, but instead of getting a present value of the free cash flows, I get the present value of the economic profit. Right? And when I sum these up, instead of getting the operating value for the first 10 years, what I'm actually getting is the change in operating value for the first 10 years. Because economic profit, also known as EVA, is about the one period change in value of the firm. All right, so I'm forecasting the changes in values each and every year. So back to the economic profits for 2014, I forecasted that. It's on the EP keyword BOY, beginning of year tab. So for 2014, off the EP BOY tab, economic profit after goodwill. Column G, row 23. That's my forecast for 2014 economic profit. 2015, EP BOY. Do not use the EOY. 2015, H23. 2016, EP BOY, I23. 2017, EP BOY, J23. 2018, K23. 2019, L. 2020, M. 2021, N as in Nancy. 2022, O. And 2023, P. Just make sure I got that. BOYG, H, I, J, K, L, M, N, O, P. Same discount factors. This is the present values. So that's my change in operating value for the first 10 years of Home Depot, approximately $10.1 billion. That's how much value they're adding. Okay. Now, I'm about to do a continuing value, but it's a different continuing value equation. The other thing, I'll go back to the PowerPoint, is in addition to adding in the continuing value and the operating value for the 10 years, I also add in my beginning invested capital. So remember, economic profit, or EVA, is about the change in value. So I take whatever invested capital I start with, and then I forecast the change in value over time. So I have to add in my starting invested capital. So I'm going to go back here, and I'm going to add in a line that says my starting invested capital. And that is going to be equals, from my TFI, the operating invested capital, including goodwill, in 2013, which was my last of my actual years of the company. So G7. Now when I add these values up, and I'm going to take the operating value plus the continuing value plus the starting invested capital, and when I add them up, spell them correctly, then I need to get the same operating value that's on my DCF tab. Those two numbers have to be identical. And again, that's going to be key to your final exam. You have to prove to me that you can do the math and come up with the same answer. Okay? Now, that means you can't just plug it in. You can't just say equals, because that wouldn't be showing me that you actually got it right. So what I'm going to do here is I'm just going to put a little check in my model. And my check is going to take the operating value on the EP tab, and I'm going to subtract the operating value on the DCF tab. That difference needs to be 0, all right, for me to have a correct answer. As a matter of fact, I know that that difference has to be that cell right there. And like I said, I will have the TAs and myself check for that on your final exam to make sure you just didn't set it equal to and solve for it. You got to actually put the formula in and get the right answer. Right? So here's what we're going to do. We got to put in the continuing value pre-discounted in perpetuity. And McKinsey gave us a formula for that. And the formula was in Lecture Note 8 in the current readings. This was the key value driver formula for free cash flow for continuing value. This is the formula for economic profit. So that big, ugly looking formula, we have to put that formula in with the correct order of operations into our model. All right? I'm 50-50 on the day. In my first section today, I got it right in the first try. In the second section, it took me 2 tries. All right? So it's a very complicated formula. It's easy to mess up. So let's see if we can get it right in the first try for video purposes. All right? So the one item that's new on this model, this formula, that wasn't in the previous key value driver formula is it's looking for an economic profit in T+1, the 2024 economic profit. So what I'm going to do is I'm going to go back to my Assumptions tab, and then I'm going to have a continuing value economic profit, which is my 2024 EPBOY tab, 2024 economic profit after goodwill. So Q23. All right. And I might do a little formatting here because that's currency, so I can switch that to currency. All right. So I'm now ready to do my formula. So I'm going to go back to my EP Valuation tab and start putting in the formula. So for continuing value equals left paren. You can see it's economic profit divided by WACC. So let's go back to my Assumptions tab. Take my economic profit, CV economic profit, divided by my WACC, right paren, plus left paren, no plat, CV no plat, times left paren, G divided by ROIC, so CVG divided by ROIC, right paren times left paren, RONIC minus WACC, ROIC minus WACC, right paren, divided by left paren, WACC times left paren, WACC minus growth, right paren. If I did it right, my difference should be 0, exactly 0. Matter of fact, format cells 10 decimal places 0. Here it's just because the number is too big to fit. Make it 2 decimal places. 42,765.4. Present value 19,808. Operating value 42,487, which gets me the same operating value as the DCF. Independently calculated. By the way, there's your final exam. See how easy it is to do the final exam? Except different numbers. And you're going to start from scratch. But other than that, easy to do.
Can you go back to that?
This one? No. Talk about that one. All right, other questions? All right, this is where we need to stop for today. So this is where we're going to pick up during our next class. And during our next class, what we're going to do is we're going to do what's called an as-is and a final valuation, in this case of Costco. All right, so coming up next, we're going to then try and value Costco very close to their current share price and talk about how to manipulate the model to do that. And then we're going to come up with our own forecast for what we think Costco's final share price should be. It's called a final valuation. So that's what we're going to do on the next session. And then once we finish valuing Costco, really the classes coming up after that will just be, we'll do a different company each class. And what you'll find is that using this model, we can quickly update the data and use this to value any company. And as somebody mentioned to me before, you'd say, well, gee, what's the trick here? And the trick is not the model. The model, though complicated, is a relatively straightforward process. And that's what I wanted you to understand. The real challenge to valuation is now we get into the art of the assumption. Because what matters is the assumptions that go into the model and how we create them. That's why on your group projects, it's so important to do the EIC to understand the external environment. That's why it's so important to understand the historical financial data so you understand what the key drivers have been historically for the company. That's why it's so important to understand the multiples and the analyst expectations about what people think is going to happen with the company in the future and how we put that all together. Right? So that's what we're going to go next with our next session. So this is going to be completing us for today. So today you just have to have a 93.32 share price. And then we'll pick up from here.